Hey, everybody. It's very nice to see you all today, although I only actually see the panelists. Really appreciate you joining us today. My name is Matt Schwartz. I'm going to be moderating today's conversation on a topic that is generating a lot of buzz and a lot of confusion, AI and private credit. As the head of DLA Piper's US finance practice, we work with a ton of private credit shops and banks, but we're focusing on the private credit piece today and how these firms both implement external AI protocols and programs and how they are developing them internally is perhaps one of the, if not the most important topic of 2026. The title of today's session is the asset class breakdown, where AI actually works in private credit. And I want to emphasize that word actually, because we're not here to talk about what AI might do someday or what it might do next week. We're here to talk about what's working now, what's not, and what it takes to get to there. I'm joined by three amazing panelists who see this from very different angles. Eric Chang, who's the CEO of Clara, Daniel Lichtenstein, who's the CEO of Hypercore, two of the main companies operating in the space, helping private credit funds, and John Markle, who is the founder and managing partner at Armentum Partners, which is the leading investment bank to private credit funds in the tech, life sciences, and healthcare space. We've got the tech side, the operation side, the capital markets view, which should give us a pretty complete picture. When we get to you, if you want to give a quick introduction, that would be great. So let's dive in. Our opening sort of thought is why AI and private credit is not one conversation. It's a multitude of conversations. A lot of these conversations skip past something very, very important. When we say AI and private credit, we're often talking about different things, different asset classes, different workflows, different levels of readiness. So let's unpack that. First question is for John. John, where are you seeing the biggest disconnect between what people think AI can do and what it's actually delivering in practice for the funds that you work with?
Sure. Thanks, Matt, and welcome everyone. Thanks for having me. Just for context, the two other panelists that are going to be commenting, they're the really smart guys. They can speak intelligently about AI. I think what I bring to this discussion is just what I've learned through discussions with several private credit firms. Our job on a daily basis is to interact with lenders. So as part of that, we always want to understand what tools are they using to do their job. So with that being the context, Matt, you're right. The way I think of it is, if you look at private credit, you have, very large global asset managers, Apollo, Blackstone, BlackRock, all the way down to, small 10-person shops like Z2 Management or Z2 Management. They all approach the use of AI very differently. What we've seen the larger firms doing where they have multiple asset class strategies in play is they're implementing AI, at least they're not using these words. This is sort of my synthesis of it, from kind of a top down okay, we have huge portfolios, we have lots of administrative challenges. Let's use AI first and foremost to help automate a lot of that stuff. Um, if I sort of, I guess I would call it uh, what the newspaper would say, elimination of headcount by using AI to do simple, easy, repeatable tasks. Sort of the classic, um, all the way down to some of the smaller firms who, interestingly, were very quick to adopt AI, thinking that, oh, well, I can use AI to do part of my credit memo underwriting. So you have, using AI to automate tasks that are done over and over and over by a back office professional or something like that, all the way to, okay, how am I going to use AI to augment underwriting? A lot of these smaller firms very quickly realized that AI was not a good tool to help with underwriting because it was riddled with mistakes and is limited to whatever data it has access to in the public sphere. So there definitely has been sort of a pendulum shift back to, okay, how do we use AI to make more efficient things that we do every day? And so the way we kind of think of it is, okay, what is AI being used for on the front end of underwriting? What is AI being used for with respect to loan level management? What is AI being used with respect to portfolio level management? And I'm going to say everything in between, like the various tasks associated with each of those things. And depending on the firm you talk to, they're at various stages there. I know later we'll talk about what specifically is happening, vis-a-vis point solutions versus platform. But right now, that's sort of how we're seeing it. To say that AI has penetrated its way into the broader credit market would be an overstatement. Lenders, by their very nature, are risk averse. So I think a lot of lenders are wading into this with, I'm not going to say eyes wide open, but certainly caution with respect to how they can use it, how it can help them do their business better.
Yeah, absolutely. I mean, I think from my experience, private credit lenders are not necessarily the early adopters of AI and how they run their business. They're all the interest level is like a 9.5 out of 10, but they're, as you say, they're sort of cautiously wading into that. So let's get to Eric and Daniel and talk about proven AI use cases where automation is delivering measurable value, because I do think that automation, agentic AI, is a place where automating tasks is sort of a lower hanging fruit for some of these. It's less risky. And so first for Eric, Eric, let's talk about ROI. Where are credit teams actually seeing returns from AI today? And where does it still need a lot of handholding? And if you want to introduce yourself, not everybody didn't have an opportunity to introduce themselves, so please take the chance.
No worries. Thanks, Matt. And thanks for having me, and thanks for everyone spending the time with us here. So Claire, co-founder and CEO of Clara. Clara is a AI fintech. We focus on what we call deal intelligence platform. So really, one other aspect, I think, Matt, to your earlier questions, also different parts of the firm have different problem sets, and we are definitely much more focused on the investment team. So the deal intelligence platform is really a tool for the investment team to facilitate three main aspects: to better manage their deal pipeline process, to better analyze their deals, and ultimately actually create a deal data set that currently firms don't have access to, and generate additional insights on top of that. It's actually leads quite well, and John, playing up off of a couple of your comments there. So absolutely, I think the full memo generation, AI is not there yet. It's not only like real mistakes, but there's also a human element to a lot of what is investing. You can show the same facts to three different people that are investing, and they will reach different conclusions. And that's why actually trades happen. If everyone had the same viewpoint, there wouldn't be much of a market. And so, where we're actually seeing really good AI cases, and John, playing a little bit to your point, two main areas. So one, not necessarily the full memo generation, but actually really around the screening of deals. So for funds, they're oftentimes there's more opportunity than you have time or resources to really diligently spend on the transactions. And how you allocate your time is actually is a really key differentiator in terms of what your firm is able to do and the alpha and return you're able to generate for investors. And so using AI really around that screening process, where we immediately, based off the information you're shown, you can quickly get to a decision. And we actually can tune that to each investment firm's criteria and their investment mindset, and then allows them to then bring in the human element, but focusing those efforts on things that are much more high value add, and seeing significant ROI, and really just a more focused opportunity set from that. To John, maybe to your second example, where things are a little bit more operational, really around the portfolio monitoring aspect of things, where this is keeping up to date on the companies as information comes through, particularly on financial data or management disclosure notes, and be able to stay on top of the news of the companies, on top of what they're reporting, and again, easily and quickly synthesizing that, not necessarily to say you do trade out a position or you add to a position, but really, again, helping you focus your efforts. Which names are the ones that you actually just need to spend more time on? Which ones you make sure you don't miss anything? You're not spending so much time on data gathering, and really more on data analysis and thinking what this means for your portfolio and for your investment thesis. I would say for both of these use cases, and where we've spent a lot of time and effort as a firm, is for each of these processes, even something as simple as, say, financial spreading or information, financial analysis. there is what I like to call a science portion of it, where it's factual, you're gathering facts and information. And then there's a more of an art form to it. And, like adjusted EBITDA is a great way where there's, different interpretations and a little bit of art form of what is adjusted EBITDA. And so in every one of these use cases, I think we've been very conscious of creating a scenario where it's a very clear handoff between what the AI does and what the human does, and that you're able to get some of that benefits and scalability of AI, but without taking away that interpretive and art form that investors really need to apply when they are making an investment decision. And that's really, I think, each of these use cases, you think about ROI, and you think about AI, it's not quite plug and play, and that's really a big challenge, and we spent a lot of time working on. And that's really where you can, when you have that combination right, you then really get the ROI and scalability and impact to the business.
That's great. I will say, as a finance lawyer, it's nice that people appreciate the art of the 3-page EBITDA definition with 50 add backs, because we spend a lot of time negotiating those and working on this. All right, so Daniel, on moving to the management side, on the loan management side, what are the tasks that funds have successfully automated, and how quickly are they seeing results from that automation?
Yeah, so also, first of all, thank you for joining us on this panel. I'm really happy to see you all. So Hypercore is a loan management software for private credit, and we typically engage with funds during their post-closing processes. So what I've seen successful are things like extracting key terms from documents into like a unified template that ops teams will use internally. Sometimes, the LSAs are 100, 200, maybe sometimes 400 pages docs. So it takes some time to understand what is going on. Or even getting like a full view of the deal in a very quick way. So like a more interactive data room. I've seen these things come to play. Additionally, if they have, and I've seen funds, our clients doing that. So with a proper modern solution, they can connect to us, let's say through our MCP, and then they can gain all the portfolio level analytics in a natural language. And we've seen that also happening with some of our clients, which, it looks amazing. They can even, create an AI bot on Slack, just asking questions about the portfolio. And it just interacts as if that's your loan admin that you're just asking questions, which also creates an opportunity to make the process much more efficient. I do have to say that there are a lot of ifs in the process. So if you have a modern solution, if you have a proper data management, if you have a proper technical team member that can deploy these agents, like there are a lot of ifs to full deployment. But when it works, it looks amazing, to be honest.
That's great. And then for both of you, you can take it in either order. Maybe Daniel, start just because you're going.
Yeah.
Is there a real difference in how you perceive AI working pre-close versus post-close on a practical basis? Or are we still just trying to figure out how we're going to do it in both cases? Is one working better than the other at the moment? Or are we still sort of in they both got their features and bugs and we're working through it?
Yeah, I think it's what I've seen naturally, the focus is on pre-closing, because there is like an element of generating content and reading a lot of content, which AI does very well. On the post-closing side, you need to build a lot of infrastructure to make it happen. And it's much more like, it's not really deep tech, but it's like a work that nobody likes to do. So what we found out is that it's actually our responsibility to build the infrastructure and then enable these additional workflows on top of our solution. So we are definitely investing in this, doing a lot of integrations to make it happen. So eventually our clients will be able to build their own AI agents, for example. But I don't think it's like one thing is better than the other. It's always a case of ROI for funds, where they want to spend their resources on.
It does sound though like and maybe Eric, you can comment on this. The post-closing piece requires maybe more technical coordination with some of their other existing systems than perhaps, or building new systems that don't exist, technical non-AI systems, than maybe the pre-closing piece, Eric. And obviously, if I'm wrong on that, tell me. And
No,
your
I'd
experience.
say yeah, you're right on that. And actually part of that is also I think there's been historically, due to technology or whatever, there's been more efforts and infrastructure, like there's more infrastructure in place for the post-close system. And so there's efficiency gains there, but a lot of firms have already spent a good amount of time, squeezing a little bit of juice. And you can always I think there is a lot of opportunity to be better, and AI opens that. But compared to pre-close, where see a lot of clients is there's no system, there has traditionally been no system in place and no data capture. So like almost the uplift in some ways, on the ROI piece more immediately in short term is on the pre-close side, and then it's more of an operational improvement on the post-close side. Like for example, another use case that we see a lot of clients is just even data capture on deals. So if you're an investment team, you may be pinged via email on a weekly, daily basis of opportunity. And currently you might have a quick skim on, what's in the email or in this, in the deck. You say yes or no. And if it's yes, you start to get data email. But all the ones that you said no to, the record of whether you looked at that transaction or not, basically just lives in your email, nowhere else. And if you want to look back at it, it's searching through. And so what we actually do on our side, just even helping firms capturing that deal pipeline data. We actually recently built, we're actually connected to your email, and it'll just like, hey, oh, this is a new deal. Let me capture the key metrics. And you're able to really leverage that on a go-forward basis. And so I think, to your point, it's actually, there's more infrastructure in place and there's more infrastructure necessary for the post-close stuff, and you have to connect with your existing infrastructure. It's also just been pre-close, been underinvested, and so it's really a great opportunity for people to recognize some benefits really quickly.
Follow
Yeah.
on quick question there. That's really an interesting point. I mean, if you're a fund and typically have a pretty wide funnel and then narrow that funnel for the deals you do, I have to think that there's information and data to be gleaned from the deals you don't do, almost as much as the deals you do do. By tracking them over time. We said no, but all, this handful of companies we said no to really outperformed. Why? What did we miss? Or, it was a marginal no. We really liked it, but it was close, but it was a way off miss. And why? Why were we only a marginal no and not a hard no? It seems that funds can really glean a lot of actionable data from what you just described, kind of scraping emails. Lawyers do the same. I was just over the weekend trying to find like a 4-year-old email on a topic. Now, fortunately, we have a pretty good system and I found it, but it was really just finding the email. It wasn't, aggregating data from all the deals that we didn't end up doing and trying to figure out why we didn't end up doing them. So that's fascinating. Okay, I'm going to move on to our next sort of topic, which is operational prerequisites. What must be in place before AI can work? We sort of talked about that a little bit. Everything that we've sort of talked about assumes a certain level of operational readiness. That doesn't necessarily mean technical readiness, but operational readiness, people ready to buy in, everyone ready to get on board. It seems like that's where maybe a lot of funds hit a wall. So can you talk about what actually needs to be in place, both on the technical and human capital side? What problems are deal breakers? Which ones can you work around? If you were telling a fund, hey, look, you want to prepare for this. This is how you prepare, right? We often on my side tell companies, and John does too, you want to prepare to borrow money. These are the things you're going to need to do. You need to gather information. You need to, get people on board. We sort of have a checklist. What would be some of those major checklist items you would tell a potential client or a client, hey, these are the things you need to really think about before implementing any one of these solutions?
Yeah, and I can start a little bit there. Like I think we touched upon a bit of this a little bit in the previous, um there the it kind of like maybe starting with the idea of the post, pre and the post that we just talked about there. I think you as a firm need to go into it, and this is where I think some of maybe the use cases that we described earlier on would be really helpful for people taking away. But it's like, be clear about what is it that you're looking to solve for, right? You just go like, I want to use AI. It could mean so many things. What part of the process, which type of deals, which teams is this, which users, like be very clear. Okay, I want maybe the data capture side is very interesting. Okay, that's the problem I'm going to solve. Like be focused and start small. And AI is amazing, but it's still a technology. And like any technology that you adopt, you really want to understand what is the impact that you're looking for and go in with that mindset pretty clear. And I think that's really the key piece from I think a mindset standpoint. We talked a little bit about the technical infrastructure side, particularly on the post close. Like if you don't have any databases, if you don't have like they're like, I think Daniel, to your point, there was a lot of ifs that we were talking about. I think particularly in post side, like if you don't have those systems and don't have some of the benefits that maybe, some of these non-AI platforms or, that already bring, you could probably start there, and you don't have to always just use the latest tech, like again going back to what problem that you're solving for. And I think the last piece I would actually zoom with like the human element, and this is where we're really working actively. It is a change in behavior, right? Investors, credit analysts, lawyers, everyone has been doing things a certain way for a while, for a long time, and it is a transformational change. And so you want to go in with openness to experiment, openness to change how you've done things. And part of what we do, and I think part of that responsibility is also on us as AI companies. And Daniel is always going to bring that AI to the user, right? It's not always users have to change. How can we minimize that transition for users as well? And that's why, similar to us, like we've built in ways that you can interact AI directly from an email, you can interact with them directly from a Teams chat, like makes it very more intuitive in places that people operate versus having to learn a new tool or learn a new platform. So I think really it's, there's a little of the technical piece, but really almost more of an operational human element of openness and being clear about what you're looking for and openness to try, that really gives you success when working with AI.
And Daniel, what about you? Do you have anything to add to that from your
Yeah,
perspective in terms of what are the roadblocks,
yeah,
And it sounds like it's actually even maybe more important on the post-closing side to at least have a sense for what systems you have in place. You're maybe
yeah,
better off without certain systems in place and starting from scratch. So it sounds like
yeah.
that's a concern as well.
I think we are at a very similar point in time where, 20 years ago, when people were looking at cloud applications, they had to understand that this is where we're going. So you need to choose your partners for the next 10 to 20 years, because the technology is evolving. And today we are at the same place. There's existing technologies or softwares that are not built to work with AI technology, so they need to reinvent themselves. And if you want to embed AI workflows within your operations, you can either think about building on your own, which is always a case, or partner with new partners that are actually working to introduce those technologies to your workflows. So I can give you an example that just to describe like how it can impact the way you operate. Like think about emails versus postal services. Like it's a completely different domain. Like it's you cannot compare these two, right? This both of them are still relevant, but we all use emails. So like that, this is the level of change that we're going to see. And
Makes sense.
and now what you need to do in order to do that, first of all, decide how much you want to invest. Like if you building on your own, either way, I would recommend to build on your own at some capacity, because today building software is much easier. So you need to have like an AI champion within the firm. For example, we are doing the same thing. We have one person that pushes the latest AI capabilities into every workflow. So another way of thinking about that, and it might sound counterintuitive, sometimes it's easier to think about the solution and not the pain point. So for example, like I can ask you, if I give you a paperclip, give me three things that you can do with it, right? You might think about three problems that you can solve. So if you think about the AI technologies that are being introduced over and over, like it's on a weekly basis now, and you have somebody that actually tries to monitor those capabilities and introduce them to the firm, you might find new things that you can introduce to an existing workflow that will just do the work 10x better. So I would find this champion or hire a champion and start looking at what we have. Do we have the right partners for the long term? If we don't, we might look for them. What processes we can now start changing with the new capabilities, because eventually uh, it's going to be embedded in every workflow.
Yeah. John, before we move on, I am curious from your perspective, sort of on the more human front, what are you hearing from, from clients in general? Are people, it seems to me there are sort of three categories of folks when it comes to AI. There are the frightened, the people who are like, ooh, that scares me. I don't want anything to do with that. There are the very technical folks who really, really know what they're talking about. And then there's a big swath in the middle of like, I'm interested in this, but I don't know what I'm interested in. What's the sense from your perspective on where funds are, most of the buy-in from their folks, just broadly?
Um, so I'm gonna tie this into the discussion you had prior to like this most recent question, which is
Sure.
around um, when you said you wanted to know, for example, why someone lost the deal or you declined a deal or whatever. So the way I think about private credit firms, what drives their decisions, um, there's not, and to contrast them with like an equity investor, there is no power law in debt, right? So if you think about how they're using AI and what they're using it for, it's very much in the non-revenue generating category. I think there are very few companies, certainly funds on the debt side, that are using AI to drive revenue. They're using AI more to find efficiencies in the OpEx area. So with respect to those, they're very quick to say, this can be optimized, that can be optimized, this can be optimized. Daniel hit the nail on the head. A 100-page credit document where five people have to call the 60 portfolio companies to say, hey, you owe us the monthly reporting data. They plug it into their spreadsheet. Oh, yep, you're going to be in breach of covenant. All that stuff can be automated. There is without doubt a reluctance to fully depend on any tool for that kind of thing. That said, bit by bit, there's adoptions increasing very, very quickly. More and more private credit firms that I talk to, oh, we're installing this, we're installing that. Um, so I think lenders have been very open and accepting of using various software tools to solve problems that they know already exist, and it's a more efficient way of doing it. Where the reluctance lies is sort of where you drift to that fronter end of the more front end of not call it the OpEx line, but the revenue line. If I take the extreme example of that, like uh, Headline or Moonfire Ventures, they're using AI for like 99% of their pipeline development, mining, feedback, what works, what didn't. We made an investment. How did it turn out? Control theory feedback loop to optimize their algorithm. Lenders are a long way off from that. And justifiably so, right? If you think about a VC firm, that it's all about power law. It's all about finding the diamond in the rough. Whereas private credit firm, they're not searching for diamond in the rough. They're making sure that every single bet they do is clean as a whistle. So I think there is reluctance around, well, how are we going to use this to generate revenue? Because that's a tertiary problem. At least that's been sort of my experience. I'd love to hear sort of what Daniel and Eric say in terms of when they try to do the sale. You never hear, oh, my problem is revenue, or my problem is pipeline conver well, everyone has a problem with pipeline conversion, but that's a whole other discussion. Um, so I think there's the continuum of reluctance through a very quick adoption isn't really a continuum. There's a hard line step function of, okay, we'll use it for these things here, which are optimizing up. I don't know if that answers the question, but that's
No,
sort of
it really
my
does.
take.
Daniel, Eric, thoughts on that? I mean, I know it's a little off script, but this is really the juicy stuff, that people want to
Yeah.
hear about.
And I mean, I think to actually just a couple points Johnny picked up, like, on the operational piece as well. And then Daniel, it's like also AI's, particularly when you look at like efficiency and workflow stuff, like connected systems are much more powerful than standalone systems. And, the connections aren't necessarily super easy, but like that's, um, I think when you look at a partner and so on, like that's what you're looking for. Like from our side, like we partnered with different, but like Allview, for example, is like a big portfolio management system within the private credit space. We partner with them, having our data directly fit into in that platform, and that's been where well seed, and you start to really multiply the efficiency and OpEx gains when these systems are connected, and that's part of I think the infrastructure piece in general too. On the revenue, um, on the revenue generating side, I think for Marcus also there's I think there's like an interest inside in any giants. Like I don't think anyone's completely solved it, but I also feel and where we're hearing from clients is, where irregardless, whether VC or private, like you're really looking for more data, and data is still a very valuable asset. And that's why I started that example. I think the example that we talked about, like sucking through your email, and like Matt, even in your example there, it's like it's only like I don't know how like you have amazing memory, but like for someone to remember an email from like that long ago, like if you don't remember, it's just it's a data point that's lost, right? And so
Yes.
I think capturing that data and the ability to capture that data is first and foremost. And then what you do with that data and information can be different. It could be as you like evaluate, we see that like evaluating investment processes, evaluating investment portfolio, but then I also could be opportunities to source. And like I think never people in some ways never had this data before. So I think we're at the very early stages of what that means. But where we're getting a lot of client interest is like, well, at least I need it, right? Like if I don't have it, I'm never going to be able to play around with it or think about what it means for me. And this is where like, think about like immediate impact of what actually AI does today versus the future. I think that's really where it's like, this is one of the areas where there's still a lot of data capture. We're actually able to create net new value for the business. And then a lot, it sort of opens up the imagination of what you can do from there. And that's really where we're getting a lot of client interest as well.
Daniel, any
Yeah,
final thoughts on this topic before we
yeah.
move on?
I think one way of looking at revenue is not only through like pipeline and conversions, it's also the quality of what is being converted eventually. And I think the technology allows smaller funds to compete with larger funds because now they have more tools to make decisions maybe even faster than they could, or capture more of the market in terms of data points and maybe source deals faster. So it just advances the market in general, and I think the ones that will implement that smartly might generate better returns. So they might not increase the amount of deals, but each deal will perform better, like from like vintage point of view, which might be an interesting thing to analyze, like over time. Like, does the technology actually impacted the returns? So I think this is one way of thinking about that. I think another way is which also like a business driver is raising capital in this market. Over time, you need to comply with more demands. What you need to report, how, what is the SLA. So even smaller firms can now, in essence, do that.
Well, I think too, I mean, we didn't talk about this, but these tools will enable better back leverage, right? If you're going to back lever your
Mhm.
portfolio with some sort of warehouse or other type of facility, having this data at your fingertips, being easily able to
Yep.
access it and show it to the lender, as if you're a fund borrower, also will help on that front.
Yep.
Okay,
So
so
I wonder also, um, I know this isn't on the agenda, but one problem everyone reads in the paper every week, oh, is there a private credit bubble? Is there a private credit bubble? And I always say, well, what asset
no.
class? Yeah, no. Well, what asset class? Because there's all kinds of asset classes. The asset class that Matt, you and I play in, um, do I think there's going to be a big explosion in loss rates or whatever? No. But the issue that I'm hearing more and more, at least to the funds that are open and honest with me, is fundraising has become a lot more challenging. So if you're a I'm making numbers up, a 500 million to $2 billion private credit fund where you focus on enterprise software, it's become a lot more challenging to raise money because your yields have come down. So if I'm going to the LPs, your next fund's not going to be 2 billion. It's going to be, maybe three quarters of that because you're not able to deploy capital fast enough. So what I haven't heard about is how LPs are using AI to assess at the fund level where they should put money. To your point, Daniel, the quality of deals that some of these private credit platforms, um, I haven't, I'm sure that exists in some capacity right now. I have no idea where that is, but I have to imagine it's going to become more and more prevalent in fundraising.
Great topic for our next webinar
Yeah.
with the funds team. All right. Well, look, there are a couple. We've got a lot more to cover. So this is actually a good transition into executive strategy, and this is for you, John. As you know, big picture. If you are an executive at a credit fund, you're the CEO or you're the CTO or on the board. How do you think of AI? Do you think of it as a bunch of solutions that plug together? Do you think of it more like a foundational infrastructure? How does that shape budget? And how do we think about building versus buying? And how should executives think about building versus buying in this space?
So the build, there's no clear answer on that topic. At least I haven't heard a consistent answer from more than two private credit firms. Um, the build versus buy, based on the research we've conducted, and when I say the research we've conducted, we, 8 months ago sent out an email to 150 private credit platforms asking them a few questions around use of AI. Um, the larger firms, with the exception of one, meaning multi-strategy asset class managers where private credit has multiple classes, they're doing a combination of building and buying. They're very much looking at AI from a platform perspective to do myriad things within their organization. And so they're kind of forcing it to be platform centric by way of filling in the gaps with their own homemade point solutions. I'm sort of piecing this together based on what I've heard. The smaller firms, again, with the exception of one European lender, are buying. It's prepackaged, and from what we've seen and heard, they're buying point solutions. We know what these six problems are. We're going to have this vendor solve these two problems and this vendor solve that problems. At least that's been my sense. A few private credit platforms have called me and said, "Hey, you seem to know a little bit about this," which is always dangerous. What do you think about this
We
firm
know a
versus
little bit.
that firm? Right. And I'm like, um, but that's sort of been my take. But to Daniel's point earlier, what we've also found is that uh, some of these certainly within the venture debt realm, some of these providers, these funds have onboarded Hypercore or whatever, and they've realized, oh, we can actually use it for these two other things as well that we didn't realize when we were buying it. So I like the paperclip analogy, which is I have this tool now, I can use it for these other things that I hadn't really thought of. So, I get the sense from an adoption perspective, we're in the early days of trying to understand, okay, how do we thread a lot of these point solutions together to call a platform? Because right now, I think there's a lot of software companies, AI-driven software companies that call themselves platform solutions, but that's certainly not how lenders look at them.
Makes sense. Daniel, Eric, any thoughts on that, or how you've experienced that with your point solutions and or platforms? I mean, you kind
Yeah.
of can both go either way.
Yeah, so I actually think that the build version is very interesting for most of them, but in practice, it's really hard because of the fact that the technology changes so rapidly. And actually, that's one of the core principles if you are building with AI in mind is you don't need to be in love with your code because maybe in a week you need to scratch it because now you have a better version, which is counterintuitive to most developers. And it's really hard to build, even though you have these tools like vibe coding that it seems like you can build things. But I think in private credit where workflows are pretty complex, it's not that simple,
Yep.
honestly, at least right now. But from buying standpoint, I think we are in a place where probably in a few years you'll see consolidation, like most tech waves. And then it really depends on the vendors who will actually build something that their customer will love it and will stick with it for the long term. And I'm in this space, Eric in this space, and we try to deliver those cutting edge technologies. But that's the kind of environment right now.
Eric, final thoughts on this one?
Yeah, I agree with Daniel there on like the build can be tempting. It feels so easy. But really like a prototype or an early version of something and something that works at scale and deals with the complexity in the corner cases is a lot harder than you initially anticipate. So actually like the 80/20 tools really valid here. And also it's like as a firm, it's like the technology is moving so fast, and even with like, are you sure you want to commit to maintaining it? It's not just building it, but maintaining it. And so you want to remember that component and keeping it up to date. And on the platform piece, I think, and touched upon it a little bit. It's also if you want to, the technology is moving so fast. You want to pick people that solve your problem, but you also want to work with people that are open with their platform and being connected. And no one's going to be the best at everything. And in the modern infrastructure build, it's all about point solutions, but being able to have them talk to each other. So you get the platform pieces and people that are willing to play and have that connectivity as part of their growth and strategy is really key. So then you're not necessarily locked in, but you're very much free to work with the partner to bring additional value add solutions.
That's great. All right, we're going to come up on our last official question, but I did want to let folks know we should have a little bit of time for Q&A. If you have a question, please drop it in the chat. Shay will kind of go through those and prompt us. I'm gonna leave it to the panelists to sort of answer this final question, which is if you had 60 seconds with a credit fund executive, CEO or CTO planning their AI roadmap for the next year, 60-second elevator pitch, what would you tell them?
Yeah.
Go ahead, Eric. You look ready.
I can start. Not timing the 60-second, but I think the concept I would just draw a lot of the conclusion about it's like, depends a little bit on journey, but especially if you're early on, start small. Pick a small problem, pick something that maybe you don't necessarily feel like it's a heart surgery about your investment process, whether that's data gathering or maybe Like somewhere start small, that could be value add. Go in with like, okay, this is what I would love to see happen. And experiment, work with a company, or whether that's yourself or like like someone like obviously like us, a little bit selfless promotion. But then like I think that would be the best way. Like the space is moving very fast, but it's also quite a big change from how things were done. And you're really, as a firm as a whole, in terms of thinking about operational efficiency, culture change and efficiency, start somewhere small, get the excitement going, get people willing to try things. And I think that will be the best way to start and get the change going within the firm.
Daniel?
I would say hire a champion, no doubt, an internal champion, somebody that will, make sure that change management is happening, and go with Hypercore. Just kidding, but I think, as Eric said, experimenting is really easy today. So with that person, just go and trial things and see what brings you ROI as soon as it can, and don't fall in love with what you see today. It's evolving so rapidly that it's mind blowing.
Yeah, that makes sense. John, from your perspective?
I think my thought's fairly intuitive for funds. I would give different bits of advice depending on the fund. So for funds that I affectionately refer to as AUM managers, so these are funds that get paid to put dollars out the door, where they're focused on a big fat management fee and care less about spread. Think about AI for getting every ounce of efficiency out of how you unlock as much dollars out of that thin spread to optimize the business to get money to the GP. For funds that are focused on return on the debt side, uh, I would actually challenge them to try to use AI to optimize pipeline conversion. I think this is done very poorly right now at the fund level, and I think everyone's looking for the free lunch where they're getting outsized returns for minimal risk. That doesn't exist. And I think AI can be a tool to sift through pipeline data that isn't used very efficiently right now.
Yeah, absolutely. I'll chime in with my own answer to my own question, because I do think that this is a bit of an underlooked aspect. My advice would be work with the lawyers that you work with on your deals to deploy capital, to talk about what would make the process more efficient. Get an idea from them what they think is working, what's not working. If you're working with a law firm that has no idea about the solutions that are out there, not really interested in your AI strategy, you're working with the wrong law firm. Because today it's not just about pushing documents out the door and getting deals closed. As this technology becomes more integrated, the lawyers who work on the deals are going to have to be involved with the workflow. So it's very, very interesting to see the lawyers teaming up with their fund clients to kind of come up with solutions that will improve the overall flow of work. So that would be my best advice. And if anybody wants to talk about that, I'm always open to it. Okay, that ends our official panel. Shay, did we get any questions in? I don't have the messaging up in front of me.
Yes, we did. Daniel, do you see them?
Yes, yes. So I can read them. We have 5 questions. So the first one is for John. Given your experience working with both large and small private credit firms, how do you see traditional operational system like ERPs comparing with newer AI-based solutions when it comes to optimizing operational processes? Are there scenarios where one approach is more effective than the other?
I think this follows what I mentioned before in terms of I don't know of any private credit platforms that are using AI predominantly for their broader ERP system. Most of them are implementing what this may be a swear word here, but here like point solutions. They're identifying problems and they're putting it out to bid. They're talking to a number of AI software companies to solve that problem. I think we're early days. It's a bit early to say that there's these types of firms that are implementing firm-wide an entire system to look after their their entire operations. It's just I'm not seeing it, not yet. It's mainly point solutions solving problems that then they realize, oh, we can solve these other three problems as well.
Interesting.
All right, thank you. Thank you, John. So next question is, what are, it seems like a follow-up question. What are some of the limitations or risks that funds should be aware of when integrating AI solutions with existing ERP or legacy systems? I don't know, maybe Eric or Matt, would you like to take this one?
I think it's
Yeah, I
good for
mean,
Eric.
I think sort of alluded with it early on, but you know, when it's more like you almost like a process or ERP, like ERP, like data, what data are you gathering and legacy, like what your legacy process is, and being clear about which pieces are not like kind of go back to that art form versus the science form, like which pieces are non-contentious, which pieces are contentious, and really more of an analysis and a data capture analysis, and going with that awareness, and then when you whatever solution you put into place, making sure that it has a very good transition between those two, and that has that ability to have humans to be still part of that process, whether it's a limitation of AI or actually just fundamentally that's something that unique to your firm, how you guys think about the deals or how you guys think about your investment thesis. And AI is never going to take that away, And so I think that's kind of what you want to think about and being clear about what is it that you're trying to accomplish, and then AI systems that I think are more open to understanding that the private credit is complex and it's not just going to be some agent that does all the work, and that there is going to be a human handoff and a collaboration process between AI and human.
Next question is, what background or qualification this champion should have? So I can answer that. I think it should be very technical, so engineer with product understanding. So typically you have engineers that evolves to product roles, and it doesn't have to be somebody from private credit per se. Like, of course, it will help, but if it's a talented person, it can understand the systems or the workflows that are happening and start to introducing new things. Sometimes a fresh perspective also helps. So this is at least my thought
I
on
think
this.
too, it's, there's an analog with lawyers, we often struggle with explaining legal concepts in non-legal ways. Same thing I think exists, right? You need someone who can explain technical concepts in a layperson's terms. So someone who not only has the technical experience, but has the human capability to translate this very technical process into layperson terms that normal, private credit business
Yeah,
folks can understand is absolutely critical.
yeah, I agree. And last question is, have you seen or can you envision AI being used to systematically analyze the reasons behind deals not done or lost opportunities, and how might such insights reshape a firm's future investment strategy, or even challenge its established risk frameworks?
Yeah, and I can pick up on that. I mean, definitely. But it all starts with actually containing the data, having the data to facilitate that first, right? Like even today, if you said a human were to do this, unless they had access to either all the people or all the thought process, like a human's not going to be, and that's going to be the same with AI. So it really actually starts with fundamentally that data capture. And what gives you, I think, it gives me sort of like confidence in saying that definitely it's like you look at the other costs, like you look at equity trading in their systematic algo trade, same with investment grade bonds and fixed income, and like like that, this evolution in terms of the advancement of the investment, how you approach investing, how you be much more data centric around it, be more data rich in this environment, and be a more critical evaluator of your own investment process and strategy has happened to other asset classes before, and you've seen evolutions of investment frameworks and risk frameworks that come out of that. You know, in part, those markets are bigger, and as private credit has grown and more matured, I think those become a little bit of an almost part necessity, but also just a part evolution of the market as it grows and as technology enables that to happen. Starting with the data layer, but then also the tooling and ability on top of that to facilitate those processes.
John, what do you think from a non-technical perspective on that? I mean, do you see?
Oh, I completely agree. I mean, we work in a market where the word private is in the market. So by its nature, I think intuitively you'd think it's an inefficient market. And for the most part, a lot of it is. However, there are aspects of it that are incredibly efficient. And where AI is going to be useful, Eric, to your point, good data in as to why you lost or why you mispriced is going to help surface a lot of the deals that you very quickly dismissed because it didn't quite fit a box that you normally check. From our perspective, if you talk to firms, they'll have a fairly well thought out broader macro strategy about a specific subsector of technology or software healthcare. What they won't have is the data on how to price within it. And that's where there's incredible inefficiencies. And that's where, we've run processes where the term sheets look the same across the board from lender. We're like, gee, this is, not surprising. But then we've run stuff where it's all over the map. It's that kind of stuff where I think AI can be very helpful to help with, again, the revenue generation, the underwriting part, the quality of underwriting that people just aren't using yet. They're just not. And part of it is, my deal flow exceeds my need to actually do that stuff. I think those days are going to come to an end. There's so much money coming into private credit that there's no free lunches anymore.
Yeah, that's great. Well, look, I want to say a very big thank you to Eric, Daniel, and John for joining us. Hopefully that this was useful to those of you listening out there. For folks who have further questions or follow-up or want to have conversations, I will tell you that both myself and John are always open to have those conversations. For me, off the clock; for him, just out of the box. I'm sure Eric and Daniel are always happy to talk about the market, how their product fits in. We hope you enjoyed this, and hope you'll follow up if you have further questions. Thank you, guys. Really appreciate you being part of it.